Hi, thanks for joining me today as we talk about consumer confidence and what that means to the stock market and the economy. So, first of all, what is consumer confidence? It's simply a measure of how optimistic or pessimistic people are about the economy, their jobs, spending, their future, and that influences how they spend. And why it matters is because consumer spending drives a large portion of our economy. 65 to 70% of GDP is driven by consumer spending. The other 35 is government spending, business investments, trade, inventories. And consumer spending has been a larger and larger percent of the total GDP over time as manufacturing goes down. Government spending is still steady, but anyway, we're currently at about 65% of GDP is consumer spending. That's why it's so important to the economy, so important to the stock market. So one measure of consumer spending that's clear and easy to measure is retail sales. That's reported on a monthly basis, and it's steadily climbed over the past 40 years. And so if you didn't create a graph relative to GDP, it would be just an even smoother line heading straight up. But when you do it relative to GDP, you can see little corrections or little downturns, I should say, in the retail sales. One, of course, in 2008, one, of course, associated with COVID. And so this matches a lot of the graphs we've looked at in prior videos where we see a big surge in a response to COVID because of the stimulus, because of the quantitative easing. People had money in their pockets and they spent, and that drove the stock market up. Now it's started to come down since then, but not in a major way. It's still quite high. So another measure of consumer sentiment is what's called the CNN Fear Greed Index, and that's measured daily. And this is simply a measure of the stock market momentum, price, breadth, how many things are being invested in, put and call options, volatility. And so it's basically saying, how's the stock market doing today? And what does that mean about what do people feel about that? So they call it the fear and greed index. Where it gets into the red, it's fear. When it gets into the green, it's greed. And so you can see it oscillates quite a bit. Like this is looking at last year. This was April. We saw the trade war heat up and tariffs heat up, and so it went towards the fear direction. So 0, of course, is high fear. 100 is high greed. And then here in November of last year, and went down again. That was for a different reason. That was because there was some fear that the AI stocks and tech stocks were overvalued. And so that's what that was about. And then here we have the Iran war. So we saw ourselves dip into the fear area 3 times in the last year. And there were corresponding downturns in the S&P 500 at the same time. Of course, this tech one influenced NASDAQ a little more than the S&P 500. But anyway, the reason I show this graph is to show that it's a horrible indicator of future performance. It's the immediate performance. It's just a temperature of where we are on a daily basis. So it's not a good predictor of future performance. Consumer spending is a little bit better. So the current situation is retail, I misspelled that. Retail sales and consumer confidence are helping keep the stock market expensive. And looking forward, these metrics will stay strong until inflation, unemployment, earnings, or world events spook consumers. So these are the good indicators of future risk to the stock market. Inflation, which is tied to interest rates, unemployment, earnings. Those are the things we're going to keep an eye on much more than consumer sentiment, because consumer sentiment is more of a point in time, current temperature, not a good predictor. So the stop-loss indicator is green for this area, and the reason is because consumer spending is strong, it remains strong, and investing is also strong. So this is just explaining one of the things that's holding up this expensive stock market. And what does this mean to buy and sell? Nothing. All the other indicators are much better indicators of buy and sell. So the valuations, liquidity, inflation, and unemployment, and margin debt are much more important to our scorecard. So when we create our scorecard and we weight each of these 6 areas, consumer sentiment is going to be the lowest weight by far. And so what we're doing is we're building an overall score across these 6 risk areas to evaluate whether to move more money into the stock market or move more money out. And so that's, if you are interested in any of the prior 4 videos, please check those out. I think they are much more interesting and informative than even this one. And next, we're going to talk about margin debt, and then we're going to compile and weight the scorecard, which will be the most useful of all, because we'll be able to look at the scorecard scores at various points in time and then compare that to where we are today. Like, what does it look like today compared to what it looked like during the dot-com bubble burst, or during the 2008 financial crisis, or during 1929, and we'll put our scorecard to the test to see if it is a good predictor of events like that. So thanks for watching. Please join me and subscribe if you found this interesting. I think that when you see the scorecard put together, it'll be even more interesting. Thanks a lot.